I think surprisingly, we're still in a situation, in spite of the fact that we had the S&P run 40% plus off the bottom and the NASDAQ more than that, in spite of a lot of new highs, you still have basically institutional investors very cautious and skeptical of this market. Yes, you're seeing some targets raised on Wall Street. But generally, I think institutional investors have one foot out the door. So I think until they're all in, this thing has legs and, final leg, not to mix up terms. But retail, surprisingly, didn't panic at the bottom and stayed, at least a good chunk of retail stayed bullish and has remained bullish here. And there, it's kind of a divergence here that's surprising because usually everybody calls the institutions the smart money and the retail kind of the dumb money, but it's been in reverse here for the last couple months. And I do think that it is, from a sentiment standpoint, there is still a very big wall of worry that provides the fuel for the advance into the top. In terms of fundamentals, I think the narrative is going to be soft landing, no recession in sight, rates coming down. That's a bit contrary here, but I do think you're going to see a big drop in rates. And I think ultimately the Fed will join the party, whether it's in July or September. I think we're going to see a rate cut one way or the other. As I've said many times, rates are coming down without the Fed. So I'm not so caught up in trying to worry about whether the Fed's going to cut in July or September or whenever, because I think the bond market is already starting to take rates down. They were 460 not long ago, and we're down to 440. They were down almost 430 yesterday, I think. So we're on our way down. I expect over the next probably 3 or 4 months that you could get down well into the threes, almost to 3% probably by fall. And that will be certainly an added tailwind for the market. I also think as we move through the summer and into the fall, we're going to see more and more of certainly Wall Street buying into the Trump policies and realizing that, yes, we are, tariffs aren't going to destroy things. We aren't going to see a big rise in inflation. The economy is actually slowing, so rates can come down. Inflation's still trending down, et cetera. I think the recognition of how much deregulation is going to help offset the tariffs, how much the drop in oil price is going to help offset any inflation fears, et cetera. I think that's all going to come together here in the next couple months to help drive this thing higher. And at the same time, I think earnings are going to be still looking very good. So, not gangbusters, but intact, meaning, you'll have some growth in earnings this quarter and nobody's going to be worrying that it's the end of the earnings cycle. I think there'll be some stimulation from rates dropping, but in terms of money, I don't think see the big money surge into the system until after the top. So I'm not counting on a lot. The Fed is not a big piece of my rationale for why we're going to into a parabolic run here. Mm-hmm. I think the big money print that I have talked about with you and for a long time, that could be to the tune of $20 trillion in expanded QE just out of the Fed, with proportionally like expansion elsewhere around the world, everywhere around the world. That comes in response to what I think is a global bust that is coming, but is just being put off until we'll go through the beginning of the recession, and then I think that morphs into a bust because of the leverage in the system. So I think both of those things are more or less 2026 stories. You could see recession, in coming months here this year, but it'll be mild enough that it won't push investors away. I don't think it's so much foreign buying, which would be more dollar related. I think it's institutions, primarily institutions, starting to go longer out on the yield curve, stretch in duration, feeling more confident that rates have peaked and are rolling over. It ironically will probably be more about the economy slowing, not expanding. But at the same time the economy is expanding, some of those early cycle things like autos and housing will be starting to go the other way because of rates. and it'll give confidence that, hey, yes, we're slowing, but we're not going into recession. Or, this is kind of that rosy scenario we used to talk about years ago. It's you get your cake and eat it too. You got rates coming down, economies growing, but not growing fast enough to push inflation up. I think if you look at why are so many, when you hear the bears come out and talk, what do they focus on? They focus on inflation going up, that it's, we've bottomed out and we're heading back higher. Tariffs are going to be part of that. They focus on the Fed and that the Fed's got no reason to ease for a long while yet. I think all those things will change in the next couple of months. And ironically, it will probably be because of a slowing economy. I do think tariffs are going to have some impact on consumers. They have to. I mean, we saw a lot of buying ahead of the tariffs. It's stolen some of the growth from the future, and the economy is already slowing down anyway. So I've even said, when we go back and date the recession, it won't surprise me if we find we've already started in one. Certainly factory orders and ISM indexes and things are in recession. The consumers held together, but we're even hearing talk about the high-end consumer, who's really been the buyer, starting to show signs of slowing. So I wouldn't be surprised if we get into recession by sometime this summer, but I don't think we'll know that for a while.